Yeah. Surprise, a little different than you're used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. All right. Hey guys, how you doing? Welcome to this live stream. It's Thursday. I did kind of signpost this on Tuesday that we were going to do this, and you're probably looking at the thumbnail and may be interested to see what this is all about. Before we actually get started, so I'm gonna scribe and stuff like that for you, because I do want to talk about how overpayments actually work, and then I'll get on to how this mortgage with, well, this provider with a mortgage with no overpayment limit also works. I'll talk a little bit about who this might actually be suitable for as well, maybe some scenarios, because I think that's worthwhile contextualizing as well. And then at some stage, we'll get into any questions that you guys might have. Can I just say, though, look, this is not me telling you to go use this provider. This is not me telling you to consider this provider in any way, shape, or form. Obviously, this is just for educational purposes. You'll use this to help you make decisions and help you make the best decision for you. It would be very, very grateful helpful if you could make sure that you smash the like button. It will just mean that, you know, other people will get to benefit from this video as well if they need to see it after this live is actually done. The YouTube algorithm will recommend it to other people. It takes 1 second for you to do so. So if you're able to do that and support, that will be amazing. And if you haven't already subscribed, please subscribe. We're at, I think, 735 or 738 at the moment. Would love to get that closer to like 41,800 over the next week or so. So your help is much appreciated. Right. Okay. So we're back talking about mortgage rates as a byproduct of inflation. You know the backdrop, all that kind of stuff. What I do want to do, though, let's start off with maybe some contextualization first and foremost. Who might this be suitable for? So I've already alluded to the fact that we know that there are probably at this stage maybe around about 500,000 now mortgages that will be up for renewal. They'll be coming out of their fixed rates in the next 6 maybe to 8 months, roughly. So this may be suitable for people in that kind of window where the fixed rate is coming to an end and they are seriously considering trying to make as much in terms of overpayments as they possibly can. Now, if that is you, this could be a good fit. But as always, I would encourage you, make sure that you're speaking to a mortgage advisor so you understand all of the pros and cons. I will take you through some of the rates that they actually have as well at some point during this stream. But I think that's important because there'll be a lot of people right now who will be coming off, 1 year, 2 year fixed rates, who may be having the conversations with themselves about making significant overpayments. And typically, overpayments are restricted to 10%. Some providers, although I haven't seen them for a very long time, offering 20% overpayments. So let's just talk a little bit about how overpayments actually work. So let's just say you have your property here, right? And let's just assume that this property is worth something like, I don't know, £250,000. This is the value of the property, okay? And let's just say that the mortgage that you have outstanding is something like £100,000, right? So this is the outstanding mortgage that you have, which means you have equity in the region of 150. Now, typically, when you look at typical, overpayment mortgages, you're allowed to pay up to about 10%. And there used to be like confusing language that the lenders would use for this. Some lenders would allow you to pay 10% of the original amount you borrowed. So let's just say, you bought this house for 250, and let's just say that your original mortgage amount, though, was something like 230, right? They would allow you to make 10% of 230. That was of the original balance. I don't know of many that still do that. So typically now what it is, they will allow you to make 10% overpayment of the outstanding balance that you have on your mortgage. So in this example, you'll be able to pay down 10K per year without any early repayment charges. That's typically how this basically works. And if you were to pay more than the £10,000 limit, they would have a sliding scale of how much you would have to pay in terms of a penalty. and that is common with all providers. So how this offering is a little different in terms of the provider. So the provider is actually First Direct, by the way. So some of you did already guess correctly in the comment section just before we actually went live here. It's First Direct. Now they are part of HSBC. They have been around for quite some time. I don't know. My experience of them being in the industry is that even to open an account with them, you need to have really, really good credit scores. It almost felt to me as though they were aiming at kind of a certain type of client. Essentially, it was I could never open account. I never was able to open an account with them. They had that higher criteria for account opening process. Whether or not that is the same with mortgages, with their mortgage customers, I don't know. The reality is, I haven't actually had any dealings with them specifically through any guise of my career. And I've worked in retail banking, corporate banking, and in wealth management. So I've not had any direct dealings with them. So I'm just saying that because that was my experience of them when I was working in retail banking, trying to open an account. It looked like they were looking for a certain type of clientele that I didn't quite match at that point in time. So First Direct at this point in time are offering you or offering clients the ability to make overpayments on their mortgage with no limit. So again, let me just go back here actually. And I'm just going to clear this off very quickly, right? Now, let's just say in this example, from speaking to them, this is how they've explained it to me. And this is what I've actually gathered from what they were saying. So let's just assume that your outstanding balance is still £100,000. Now, it is important to note the term of your mortgage here, okay? So let's just say you had 20 years left on your mortgage, 20-year term. That's for your entire mortgage, not your fixed rate. I'll come back to why that's important in a moment, according to the way they explained this to me. And hopefully I don't get this wrong, but I'm sure you can go and do further research. So your outstanding mortgage is £100,000, right? Now, let's just say, for example, you were to go and take something like a 5-year fixed rate with them. And let's just say their rate at this point in time was something like, I don't know, 5.24%, right? Now, within your 5-year term, you could make an overpayment with no limit at all. The only thing that you cannot do is you cannot pay off the full amount. Now, I actually asked them, well, how much can I pay off? Is it a percentage of what's outstanding? So is it, say, 10% of the £100,000 that I have outstanding? Is it 5%? Is it 20%? They couldn't tell me. What they told me was, and these were their words, was it depends on how long you have left on your mortgage overall, which is the 20-year term, and your monthly mortgage payments. So let's just say your 5-year fixed rate came at something like £600 per month. It will be determined by this overall term and your monthly repayments on this 5-year fixed rate deal. And they calculate that per person. So I guess if I was using this as a customer, I would be a little bit, okay, I don't know what that limit is and if there will be any penalties. There are only penalties, from my understanding and speaking to them, if you pay off the full amount. And the early repayment charges, if you pay off the full amount, the early repayment charges go something like, it was 3% of the total amount on the mortgage in the first year. This is in the first year. And then it was 2% of the total amount for every year past that. So, for example, if you're in a 5-year fixed rate, the first year you're going to pay 3% of the total amount. And for the first year, for 1 year, and then for the other 4 years that you have, or whatever term you have left, it will be 2% of the total amount that you'll pay. It sounds a little convoluted. You'll need to have a look at the actual detail, but that's what I've been able to find out in terms of this right here. Now, who will this help and who might this be suitable for? I know ever since we've been speaking about this here on the channel, interest rates and overpayments and all this kind of stuff, there have been a few people who have reached out to me, who've been like, look, Pete, I'm not really too sure on what I'm actually going to do. The options are vast out there. People have been asking for guidance and stuff. And I think it's really important, if you're going to try and approach this, that you try and get as much information as possible. And it's really all about what your finances currently look like. Are you realistically in a position where you are going to be able to make significant payments into your mortgage that will breach the 10%? If the answer to that is yes, then this might be a really, really good thing for you. If the answer to that is no, well, you might not even be bothered with this at all. But I think there is also a window of opportunity here specifically. And I'm speaking to people who may be having their mortgage come to an end, and you're within that 6 month window where you can begin shopping around. And if you are so inclined to say, actually, you know what, I've got a big chunk of cash lying around, or I think I'm going to come into a bit of money over the next 2, 3, 4, 5 years, and you just want to be able to throw that into the mortgage without there being any early repayment charges because you're breaching that 10% limit, this could be a really, really good option for you. Potentially. It isn't going to suit everyone, though. I did have a little look on their website just to kind of get an understanding of the kind of rates they have available. And they're not too dissimilar, I gather, from other providers at this point in time, just looking at the kind of rates that they have. And I'm just going to share this with you. And I encourage you as well, go and have a look at this yourself. Go and have a good look at this and try and do a comparison yourself just to see how you actually come up in terms of the rates they have available. So this is their website here, and I just punched in a little bit of detail here. So property value 270, outstanding mortgage of £100,000. Actually, let me just do it exactly as we did in the example here. So let's just do 250, and let's just do 20 years left on the mortgage with £100,000 balance. Okay. Now we're going to look at full repayments, and you can tweak this. You can go offset. If you don't want to offset mortgages, it will be beneficial if you have savings. So let's just say you have like £30,000 in savings, right? You could do an offset mortgage where the balance that you have in your savings account will be used to offset your mortgage and therefore save you on interest that you're paying on the mortgage. It's good to see that they have these. I don't think that these are too common these days, but it's nice that they have these. But we're looking at full repayment for this specific example. Rate type. Well, we can have a look at all of them: fixed rate, tracker rate, standard variable rate. Just bear in mind, if you go on a tracker rate, if the Bank of England base rate moves, this will also move. And standard variable rates is probably one that you want to stay clear of. If you paid attention to the live that I had with Fumi, maybe about 3 weeks ago, you'll remember that she was saying that some standard variable rates are like 7.99%. That's probably the last place you want to be. So fixed rate, if you want to know for sure, right, my monthly payment is going to be this over a 2, 3, 4 year, 5 year period, even a 10-year period, because you can go up to 10-year fixed rates now. And you know that you're going to be able to use that as a solid base from which you can actually budget and get yourself organized. So if you just go refine searches here, it will just kick out some of the offers that they actually have for you. What did this just do? Okay, I've got to redo this. Right, remortgage. What did we say? 250. We were looking at £100,000. And then we did repayment, all types, and we put 20 years here. All right, here we go. So this is just an example of what they have right now. So from what I gather, a fee saver offering here means that there are no product fees at all. So there's no booking fee, there's no arrangement fee, there's no fees at all for this. Now, they've got a 5.84% for a 2-year fixed rate. I mean, bearing in mind, this is a relatively low loan to value. So this is maximum of, this rate is available for maximum loan to value of 60%. Now, actually, let me just be maybe just a little bit more dramatic with this. And let's just call this 200 and increase the loan to value just to see what the difference actually is. I think that will be useful for people to be able to see if there's a vast difference. Yeah, so look, 5.98%. Yeah. So these are the rates they have at the moment. And again, plug in your details, have a look if you think it is going to be suitable for you. But by all means, please speak to a mortgage advisor. Don't, look at this and be like, right, I'm just going to jump on really quickly. Speak to a mortgage advisor or speak to one of their providers, one of their mortgage experts there, and have a chat with them. But yeah, based on this, 5.98% is what you're looking at here for a 2-year fixed rate. You can have a 5-year fixed rate of 5.36%. They've got one at 5.18. I mean, I say for a 10-year fixed rate, ugh, I mean, a lot can happen in a decade, right? Interest rates might come down. You would need to really have a really good reason why you go for a 10-year fixed rate at this kind of level. Um, because if interest rates fall in, 5, 7 years years from now, and you're locked into that, you might kick yourself. But again, it's all about whether or not the monthly payment amount is actually going to be affordable. That's really going to be the deciding factor. And if you know that there are certain things that you need to be mapping for over the next 10 years, that maybe you're working towards specific goals, maybe university fees, so on and so forth, and stabilizing your mortgage payment becomes an important factor, you may decide that actually this is the right thing for you. So it's all based on your personal circumstances. This right here, I mean, look at that. This is a live tracker at 7.554%. Ugh. I mean, that's pretty expensive. They do have a 5-year fixed rate of 5.27. I mean, I was reading earlier today that the average 2-year fixed rate is like, I think it was like 6.2 now, or 6.3 or something like that. I think I was reading yesterday. Yeah, another live tracker here at 7.39. Look, this is just an option. If you are in a position where you are looking at your mortgage and you're thinking, okay, should I be overpaying? This may be a really good option for you. It might not be, but I think it's better to know this kind of stuff and to be aware that it's out there. So you can just include it in your basket of choices. And you can do a pros and cons, a comparison between this one with, I don't know, Barclays, Nationwide, whoever, and use that as a barometer of where you would like to go. But that's what I thought I'd cover in this live here. Let me just see what people are saying in the chat. Wayne, what's going on? How you doing? Saeed, how you doing? Let's have a look. No, this is not Barclays. So this is First Direct. And by the way, just for the people who can be cynical, this is not a paid video or anything like that. They're not paying me to do this video at all. Although it would be nice if they did find this and wanted to reach out and actually do some work. That would be amazing, because you'll be amazed how many times I've received messages from brands where I've spoken about them and they're like, "Oh, you did a really, really good job, by the way. Thank you." And then nothing. So if anyone from First Direct does watch this, you want to reach out, please by all means reach out and let's talk about maybe doing something properly. Maybe get you guys onto a live where you can actually talk through products and what you're doing and so on and so forth. That would be amazing. I think people would find value from that as well. Let's have a look at what you guys are saying. Look here is just saying it seems too good to be true. How will the bank make money? Hope this is not a 419. I don't know, mate. This is for you to double check with them. They've been around for a very, very long time. Like I said, there are early repayment charges in there. So it's not like you can pay off your mortgage all in one go. They are just unique in the fact that they don't have any limits on how much you can overpay as long as you don't pay it off. I would imagine, like I've already said before, my experience of them was they always kind of went for a certain caliber of client. At the time I did not meet, so they may be aiming this at customers, people who will have large mortgage balances. So you're talking, 500,000, 750,000, a million plus properties, where the client archetype might be they are self-employed or they are in business in some way, shape, or form, and they want the flexibility to be able to pay off large chunks of their mortgage on a sporadic basis as and when things happen. Because there are plenty of clients like that, plenty of clients who run businesses who may say, well, actually, you know what, I've got some dividends coming this year, or I've got some profit share, whatever, I'm just going to throw that onto the mortgage, and they want the choice to be able to do so. I would argue that maybe that's what this is the kind of client or the archetype that they're aiming for. That would be true based on my experience of them when I was in retail, but I don't know whether that is true. I haven't been in retail for a very, very long time, so it's very, very likely they're aiming for a top kind of echelon type of client where the mortgage amounts are so much larger, where actually they make more money on the larger mortgages and so on and so forth. And then tied into that as well, possibilities that you also get their current accounts, credit cards, all that kind of stuff as well. Banks will often use one product set to try and bring people into others. So current accounts, credit cards, investments. They might have personal bankers, and the First Direct brand, again, from my recollection, is they were always very. I mean, I tried to open an account years and years ago, and even though I kind of had I didn't have a semi-good credit score. Actually, it was still crap at that point, but I found the barrier to entry quite high at that point, and it felt like to me like even speaking to some of my mates who worked for HSBC, who this is an arm of, was like some of their top clients basically went there. But who knows? This is a question that for you to ask providers, because it will be part of your research, right, when you're looking to use them. Zero, thank you, mate. Thank you for the reminder on this. There's 41 people on here at the moment, so it'll be great if we can get the likes up to about 30. There's about 19 on here at the moment. Thank you, dude. You always do a job for me on that, so I appreciate it, mate. Thank you. That's the way Nationwide mortgage works. That's where your Nationwide. So you're saying that Nationwide have the similar thing? I didn't know that Nationwide did. I thought Nationwide had a 10% limit on what they on what you can overpay. Or at least they did when I worked for them many years ago. They may have changed it. Who knows? All right, someone's asking here, what if it's not on a fixed rate, on a variable rate? I think it's still the same whether you go for a variable rate, a standard, if you're on a tracker, standard variable, or on a fixed rate. I think with the early repayment charges, though, because you're not in with a term, they'll probably execute that in a different way. I don't know how that would work, though. That will be a question that you would need to ask them if you decide that you wanted to use them, because it is a good point. If you're on a tracker, I mean, if you're on a tracker, you'll be on a 2-year or 3-year tracker anyway. If you're on a standard variable rate, you won't necessarily have a term. So how would they action the early repayment charge? I don't know. It's worthwhile checking. But even if you're on a tracker, you would have maybe a 2 or 3-year tracker. So the early repayment charge will technically work exactly the same. Cheers, dude. Thank you very much. Thank you for smashing that like button. Appreciate it. Thank you very much. Right. Ahmed, what do you think about overpayments in a situation when you are already on the lowest loan to value? Is it better to hold the cash in that case? I mean, look, I think it's really important just to kind of understand here, because a loan to value will only gives you access to better rates. Yeah. So if you have a loan to value of say 40% or 30% versus someone who's got a loan to value of 80%, there's less risk for the bank, for the lender. So they give you a better rate as a result of that. If you overpay your mortgage, what you're essentially going to be doing is you're going to be saving yourself on interest payable on your mortgage, and you're probably you will in fact truncate the time down for you paying your mortgage off. So it's almost like a double whammy in my head, right? You're saving on interest, you're paying it off a little bit early. Now, you could go and put that money into cash, but as you know, inflation is pretty high at the moment, 8.7%. Interest rates haven't quite got to that point where it's going to offset or get you in a better place than the prevailing rate of inflation. So many people will argue in this, and it is down to personal preference and it swings and roundabouts. Many people will argue, well, actually, I would rather just pay off the mortgage because I save myself on interest and reduce the mortgage term quite significantly. I've got that peace of mind that my mortgage is going to be done fairly quickly or soon, versus okay, I've got the cash there. Now, having cash will give you peace of mind that you have cash, and if that is the overriding factor that will help you sleep better at night, then that's probably the right choice to make for you. But in this instance, right now, I don't think that having cash and putting cash aside solely for the interest rates, whilst inflation is so high, necessarily makes sense when you compare the numerical value of what you'll save on interest and just the knowledge that you're paying down your mortgage quicker, if that makes sense. Let me know what you think, and let me know if you have any follow-up questions in there. But that's the way my head goes about thinking about it. And again, this isn't to say that I'm right, but it's just giving you food for thought. Maybe some things to consider in your decision if that is your situation, that's what you're looking at. I mean, for me personally, I've been thinking about it, for probably a good couple of times, and I've shared it here. I'm probably going to really push push to pay down the mortgage in the next 2 years. So I'm going to be mortgage free in the next 2 years, assuming I'm able to continue working, because I still need to do a lot of hard work for that. Pay down the mortgage in 2 years, and that way I can restructure my approach to investing. I'll be able to throw way more money into it, but I know that the roof over my head is completely done, and I will be 100% debt free, because at the moment my only debt is the mortgage. So whilst interest rates are high, yes, I could throw more money into the investment markets, but actually I like the idea of having the peace of mind of actually my mortgage is paid off. It will give me a sense of more freedom, in terms of I can pick what I want to do in terms of work, even more than I do right now, because I'm quite picky in things that I do and don't do. I can be even more picky. I can basically design my life and what I do based on the fact that I have no debt, really, and that sense of freedom and security is I guess what a lot of people really want. Cameron is asking here, thoughts. Could you do a money transfer from your credit card to your bank account and use it to make an overpayment and pay back the credit card? Fees can be as low as 2.5% with a 0% interest. You're using debt to pay debt, though, so you're still in debt. So if you did that, I'm not too sure what the logic would actually be. You're saying fees will be at 2.5% with a 0% interest. 0% interest on what exactly? Because credit cards will normally say 0% interest on purchases. That wouldn't be a purchase. You wouldn't get 0% because you're not transferring a balance. So you're not doing a balance transfer. What you'll be doing is you'll be using the card to pay off part of your mortgage. To me, it doesn't make any sense. It's counterintuitive, because you're still using debt to pay off debt. So in the long run, the credit card will cost you more than it would do the mortgage, because typically, unless you have an ace credit score, your credit card rate will be in the double digits, whereas at the moment, mortgage rates aren't. So that seems a little counterintuitive to me. You would have to sit down and punch the numbers, mate. But you wouldn't get 0% on purchases, because paying a credit card, using a credit card to pay your mortgage, that is not a purchase. They wouldn't class that as a purchase, and it's definitely not a balance transfer, because you're not transferring between two cards. So I'm not sure how that would work personally, but yeah, I could be wrong. Is interest calculated daily? That I don't know. I can't answer that with any particular level of confidence. You will need to ask them that directly. Most mortgages will have a daily calculation in there. I mean, that's typically how most interest rates will work. There's a daily calculation behind it. But you should probably ask them that question, because I can't answer that for sure. I don't work for them. Saeed, would be good to have a lender giving an insight to their lending criteria, just what's available to the public. Do they? Yeah, they don't, unless you go through something like if you go through a mortgage advisor, or you speak to their in-house mortgage providers, they'll tell you that, look, the main things that they're looking at, very, very high level, and some of them will have different variations of this. But for you to apply for a mortgage, they always have affordability criteria. This is really their lending criteria. So what they're looking for is they're looking for your income. They're also looking at your expenditure. And really what they're looking for is they're looking for, some cushion, some leeway between what you earn and your expenses going out. And the larger your kind of cushion is, so the less you're spending versus how much you have coming in, the better it is they're likely to accept you, right? But the thing is, particularly from a mortgage point of view, they may initially, so typically they will say you can borrow 4 times your salary, right? So let's just say you're earning 50 grand a year, then that's £200,000. But when they start looking at your income and your expenditure, there are certain things on your expenditure that they will almost penalize you for. So for example, if you have car finance, if you have credit cards, if you have personal loans, those type of things will reduce that £200,000 that you could borrow. Because what they do is they view that as committed expenditure. So, for example, if you have a personal loan and at the time of your application, you've still got 3 years left on a personal loan. But what they'll do is they'll do a calculation based on your payments and your term, and then they'll deduct an amount from the £200,000 you could originally borrow, because you have to make payment to that credit commitment over the next 3 years. Now you bundle that in with car finance and maybe, I don't know, any other debt that you actually have. All of a sudden you could find that you went from £200,000 to only being able to borrow 150 or £160,000. So I've seen those things actually happen. So that's why I always say to people, when you're applying for a mortgage or something like this, it's really, really important to make sure that you pay off as much of the outstanding debt that you have. And this is where people get very, very outlandish with the cars that they drive. They go and buy big cars that really they don't need. It's in instances like this where there's a remortgage happening that decision comes to bite you in the bum, because your car payment, which is 500 quid a month, that significantly can reduce how much you can borrow on the mortgage potentially. So they do kind of give you an insight when you are going through the process. I think the problem is a lot of people just don't know the right questions to ask, really, or maybe in the moment. I mean, I've been there. When you're applying for a mortgage, you just want them to say yes, right? So I think from a psychological point of view, that's where some people find themselves. So they don't necessarily want to ask the right question, because I don't know. I've certainly sat with people who have said, if I ask the questions, I worry that they might think that I'm not credit worthy, or so on and so forth, and therefore they just don't. Um, and I can see that. I can see, because it's human psychology. You're looking to borrow quite a significant amount of money for quite a significant thing. You don't want to ask questions that you think, oh, well, could they see that as a red flag? It's the same thing as, what's on Sky News talking about the measures that they introduced for mortgages, and one of them was so ridiculous. It was, you should be able to speak to your lender without fear of it impacting your credit score. And I'm like, it doesn't anyway. But the reason why they put that out there, and I said this on Sky, it's a good thing, because at least we're talking about it in the public domain, that it is not going to impact your credit score. But the reason why they did that is because there was a research piece by the Financial Conduct Authority, the FCA. And actually, when they polled the general public, that's what the general public thought. They thought if they went to their mortgage broker or their mortgage provider and said, look, uh, I'm finding it a little bit difficult, they thought automatically that there was a penalty and damage to the credit report, and there isn't. So it's little things like that we think of in those kind of situations that aren't necessarily true. It's kind of like it's mythical. It's mythical. Thank you, dude. Thanks, Saeed. Like I said, I've still got to do a lot of work for that, to be honest. And I'm in the process of actually paying off a chunk right now. Um, and trust me, like, do I want to be putting it into the mortgage? Could I be doing something? Could I be doing something else with it? Yes, I could. Have I been tempted to change my car? Yes, I have. I've been tempted to do a lot of other things. I've been tempted to go and buy other property potentially with it. But when I think about what my plan is over the next, 5 years in that medium term, none of those things, kind of buying a property, I can always get on a property ladder. I can buy an investment property later on if I wanted to. Nothing's going to stop me from doing that. Could I jump in it a little bit earlier? Yes, I could, but it doesn't map to my 5 year plan. So there's still a lot of work to be done in order for that to happen. But I think it's important to have these kind of conversations, because hopefully it gets people thinking about, what might be possible for them, or, seeing things differently to what maybe you perceive are the only options that you have available. Cedric Powers, clear my mortgage up to my risk tolerance massively. Now, this is a good point, and it's something I always hear. And for me, in 2 years' time, if I do have it paid off, I could throw money into investments without really worrying, because yeah, okay, I still need to retire maybe in about 20 odd years, but it's still 20 odd years. So I can up the level of money that I'm investing. I could up the risk level, because I haven't got to pay for a mortgage. I don't have to pay for a mortgage. What have I got to pay for? I haven't got any debt. I haven't got, all I need to make sure that I can pay for is my living expenses. And if I can keep that relatively low and still earn really good money, happy days. So I completely resonate with this here, because it has occurred to me, and it's allowed me to make me to make more money than anything else I've ever done. It frees up that space and the choices. You can be a lot more picky. And I've spoken to people who I know who are mortgage free, and it's like they that was one of the things they said to me. Your mindset shifts because the necessities are done. If you really want to then focus on building a business or doing something that you're really passionate about, and I'm already building a business here, just knowing that I don't have that pressure means that actually I can be a bit more picky. I can go after specific things. I can maybe do things that I never would have thought I would have done before because I've got to pay the mortgage, right? So, and this is, I love this comment. Thanks, Cedric, for that. Really, really good. Debt at a cheaper price. I don't see how it would be cheaper, mate. I don't. You're trying to say that a credit card will be cheaper debt than a mortgage. What credit card is this? If it's not on purchases, because some of them will offer really low rates on purchases, some of them will offer really good rates on transfers. But for general use of the card, I don't know any of them that would offer you a rate that will be cheaper than a mortgage. I haven't seen it in the 15 years that I've worked in financial services. Um, but again, I could be wrong. If you've got an example, let me know. It doesn't matter if it's a money transfer, though. There's still going to be a rate for the money transfer. So, I mean, look, if you guys, if you do have an example of it, by all means, ping me, maybe a message or a link or something like that on Instagram, and I can have a look into it. It might be a case of conversation that we do on a live, and maybe I do a comparison of saying, well, actually, would this scenario really work? Maybe I can crunch some numbers and have a look and say, well, actually, if you put this on a credit card and moved over, it paid some of that off the mortgage. The thing is with a credit card is you're not guaranteed to get the amount that you need, right? So let's just say you wanted to pay 20 grand on your mortgage. You may not get a credit card limit of 20 grand. So what are you going to do? You're going to take out a credit card for 3 grand to pay off your mortgage. That almost doesn't make any sense because what dent are you really making? Yes, you'll be able to save yourself more interest. It doesn't make any sense on the surface for me thinking about it because if the idea is if you're going to be making overpayments on your mortgage, why take it on a credit card? You're still using debt to pay off debt. So you've still got debt. You still owe the same amount, but in an ideal world, if what you're saying is true, you've just got it at a cheaper rate, but you're still in debt. The whole point of overpaying your mortgage is to reduce your overall debt liabilities, right? It's not to acquire more debt to pay off debt. It's the same vicious cycle. You're in the same thing. So the thinking is counterintuitive to me. What I don't understand is how the overpayment saves on interest. Is it because an overpayment goes entirely to the capital? Sorry if this is a dumb question. No, it's not. So basically, if you think about it, right? So let's just say your balance on the mortgage is £100,000. Yeah. Over the 20 years that you have that mortgage for, the provider is calculating you're paying interest on that £100,000 over the 20-year period of time, right? So if you pay off £20,000, you've reduced your debt to £80,000. Therefore, the interest that you would pay on that 80 grand over the 20-year term, if you kept it at that term. So again, I did a video with Sprive. The app is Sprive, or you can just go online. Let me actually see if I can find one here to share with you guys. Mortgage interest. Is there going to be one here? Here we go. Have I done the right search here? 1 second. No, it's not. I don't want this one. I'll see if I can do a live example for you. Mortgage account. Is it this one? Let's have a look at this one. Okay, right. Let's see if this will work. And I'll share my screen with you if it does. Let me just have a look at this. I'm just going to do 5 here. Okay, no, wait. What have I just done there? Let's do 150,000. So 100,000. Yeah, that's right. And let's just do a 5 here. Let's do 20 years. This is an American calculator, so it may not be the exact one that we need. But let's see what it throws out. I need to know what interest. Okay, so it does give us an interest paid here. So let's just do 2 examples here. So this first one is 58389. 58389. Okay, let me just share this with you so you can see what I'm doing. Let's go here and let's punch in over here. All right, okay, cool. So what I've done here is I have put in here, right, your home value is 250. You've got £150,000 worth of equity. Your loan amount is £100,000. Interest rate is 5 years. And you're doing this over a 20-year term. Now, forget the payments because that's what the payments are, right? This is the bit that you're interested in. So this will be the interest that you would pay over the course of the 20 years that you have left on the mortgage. So 58,389.38. Now, that's how much you would pay if you didn't make any overpayments. Now, let's just say you made an overpayment of £20,000. So your loan amount would go down from 100,000 to 80,000, right? Let's just recalculate this. Look how much that goes down to, 46,000. So let me just grab my calculator. So we had 58,389 minus 46,7. 58,389 minus 46,711. So that has saved you £11,000 in interest. And just let that sink in for a second. You've overpaid 20 grand and you've saved yourself £11,000 in interest over the course of that. Quite powerful. So that's how it works in terms of the interest and the overpayments, which is why it's worthwhile considering. Look, for most mortgages, and this is the thing that can be quite sickening. If you borrow £200,000, right, on a mortgage, you're likely paying that again in interest over the lifetime of your mortgage. It's the banks make a ton of money on mortgages. That's why it's so lucrative. So it's little things like that. You may think, oh, over 20 years, that's not a lot of money, but actually it is when it adds up. And at least it's not money that you're giving to the banks. That's how I look at it. It's money that you're keeping within your pocket that you're not having to pay in the future. If daily interest could overpay weekly, daily to cut interest monthly. Look, if you use, again, apps like Sprive, so SPRIVE, they talk about how they are designed to help you understand the impact of overpayments. A lot of people think you have to have a lump sum to make an overpayment. The reality is you don't. You can overpay by £10, £20 a month, and it will still have a big impact. And Sprite has a feature in there that you can actually plug in your details and you can say, right, if I overpay by 10 months, what is the impact on the interest? And it will show it to you plain and clear. So it's free to download. By all means, go and have a little play around with it because it is very, very worthwhile. It really, really is. Yeah, there's an answer there from Wayne. Let's have a look at what SEMA, what you're saying. Do you mean a loan to value of 7% will get a better rate than a loan to value of 70, or is there an upper limit to it as I generally don't see anything more than a loan to value of 50 to 60 in bank online informations. So the lower your loan to value, so the lower the amount that you're borrowing against versus that the value of your house will typically give you a better rate on offer, right? So if you had, say, a 70% loan to value, you're going to get a higher rate than you would get if you had a 60% loan to value. Now, First Direct on the screen that we shared here, I think their maximum in terms of their ceiling was 60%. So it doesn't matter whether you go 30%, the rate that you're going to get is the 60% ceiling. That may be different for different providers. So maybe that's a question that you also want to ask and explore when you're speaking to to the providers or speaking with a mortgage advisor to help you understand all of the options. What is their ceiling in terms of their best rates on the loan to value? I just locked in at 4.75% with a loan to value of about 40%. And it didn't matter if I was with a loan to value of 30%, it still would have been 4.75. So yeah. So you're just saying when I cleared the mortgage, I stopped taking BS at work too. It did wonders for my self confidence. I bet, mate. I bet. Do you you can do 0% transfer to your bank? Both my cards offer it. Okay, that's good. Is it the same bank or different bank though? So in that instance, you will need to have your mortgage with the same bank, right? Pay off your mortgage. Pay your mortgage off. That's base one on the baseball pitch completed. Now get to base two. Indeed, indeed, indeed. So I'm just saying here, personally, I wouldn't use it to pay off my mortgage unless I was clearing it. Jamie, if you don't pay off your mortgage, who will? Pass the debt to the kids, clear the mortgage, and have a zero debt. Very, very true. NatWest are doing 0% fee, 0% interest over 19 months, 4% easy access savings account, and pay credit card from the account. So doing the 0% fee, 0% interest over 90 months, which is going to be on credit cards, 4% easy access savings account, and credit card and pay credit card from the account. Yeah, I can see. Yeah, I can see how that would. I can see how that could actually work if you have a little bit of cash in there, for sure. Because at least you're getting 4% on that, and then yeah, the credit card's 0%. You're getting 4% on a set. And this is what I alluded to earlier. A lot of the time, the banks will use offers and link them to other accounts so they get more of your holdings in one place. And this is a prime example. So what they'll do is they'll offer you a credit card with 0% fees, no interest for 19 months, but you've then got a 4% instant access. So in this example here, yeah, you put maybe, I don't know, whatever money you have in the easy access account, 4%. If you did have a balance on the credit card, you can then just pay off the credit card from the 4% account because you're not paying any interest on the credit card. That puts you in a positive position. Disregard inflation altogether in that equation. You are winning. You're in a better position overall in this example. If you pay your mortgage off and you have children over 25, will they have to put the house in a trust if anything happens to us to stop the tax man? This is an inheritance tax question. It depends on the value of the house. It depends on your assets overall, and if you're married or not. So if you're married, you get more. If you're not, you get $500,000. So for a married couple, including assets and property, it's £1,000,000. If you're single, it's £500,000. So as long as you don't breach those thresholds, there will be no tax. But then again, properties appreciate in value. So if you have a property that is, I guess, going to put your overall push you past the £500,000, then you need to start planning a lot earlier. So trusts are one thing that you can do, but you need to take advice on how you set that up properly. I've had someone ask me to do a video about trusts. I don't want to do one purely because it is quite a specialist area. And I have worked with trusts as a financial advisor, but I would put them in front of a trust specialist. So I don't want to talk about it because it's not really my area of expertise. You need to make sure that you're doing it in the right way. But what I would say is if you do have children, you have to keep an eye on your inheritance tax liability, your the value of your assets over a period of time. And the way we used to do this as financial advisors is we would take a snapshot now, and then you would reassess maybe every year, every 2 years to see, right, has property gone up? Has it pushed you past the threshold? And you would do that whether you're single or whether you are married, because you just want to be able to preempt if there is going to be an issue. And then even if you don't put things in trust, there are very, very clever things that you could do where if anything happens to you, there's something that pays out to satisfy the inheritance tax bill. They're clever things, but you need to take advice essentially. Jimmy saying, forget the money part. There is something spiritual and significant for the mindset in being able to say that you truly own your own home rather than co-owning with the bank. Yeah, I would agree with that 100%. 100%. Hard to forget the money part. All right, let's have a look and see. I'm just going to scan here. Am I at the bottom? I am at the bottom. I think I am. Yes, I am. Think it's better to save for a house. I think it's better to save for a house and buy it cash rather than mortgage. I mean, in an ideal world, yes. The reality is there's not a lot of people that are in that position to be able to do that. I mean, that's going to be heavily dependent on you. You're earning really good money. You're disciplined. You've got real structure. I mean, if you're able to achieve it, bravo. And there's a lot of people who want to be in that kind of position. It's very, very few people that get to attain it, though. That isn't to say that it's impossible, but yeah, it's quite hard for a lot of people to get there. Yeah, you asked the question about doing the video. Yeah, so again, the reason why I don't want to do that specifically as a topic is because it's quite specialist. And when you start thinking about, because then you have to delve into what kind of trust do you use? You've got absolute trust, which can't change. You've got discretionary trusts. You've got bare trust. There's so many kinds of trusts. So if you're thinking about a toolbox with maybe 15 different tools in it, what's the right one to use for the job at hand? And because it is so specialist, there are so many considerations that I don't want to make a video where I'm too loosely ambiguous and someone then makes a decision based on a YouTube video of I'm going to use this, when in fact, if you look at your personal circumstances, is actually the one that you pick is wrong. So yeah, with trust, you do kind of need professional help. You really, really do. Cameron, thank you very much, mate. Now let's have a look at these. There we go. I'm just going to pop this up. I'm going to leave this up here. Over 70 people, only 35 likes. Come on, people. He's delivering gems the size of a cantaloupe melons. Smash the like button. Be nice and be blessed. Thank you very much, mate. Yes, and look, you may think that it doesn't matter, but it really, really does. And it takes you a second to do it. We've spent 51 minutes at this point on this topic here. And look, at the end of the day, it's trying to have conversations that I hope you'll find useful, give you some food for thought. You can ask questions, you can get answers. And, for that 1 second it's going to take for you to smash the like button, it will mean that when I press end on this broadcast, the algorithm will look at the stats and be like, okay, people actually enjoyed this. The algorithm will then push it to other people who might also benefit from what we've been speaking about. So it's a very, very small gesture, but it makes a huge difference in the scheme of things in terms of the reach that this video will have for other people. So thank you for smashing the like button. And there we are. It's like right up there. Someone's asking here, other alternatives for trust for children. Can you put them on the mortgage and overpay together? You got to be really, really careful, mate. I mean, look, you can't put a kid on a mortgage. They have to be of legal age first and foremost. So you just can't put them on a mortgage. If they're more mature, then possibly yes. But then look, HMRC is not stupid. If they think that you've done something retrospectively only to dodge inheritance tax, they're going to know. And sometimes it doesn't always work. And this is the danger of, many people will say, oh, down the pub, my mate said this and did this. Like, you don't know what really happened. It may have worked from an application point of view. Yeah, they go on, but there's something happens and HMRC looks at it and goes, nah, we don't like this. You don't want to be in that position. So, I always say, make sure that you seek appropriate advice, particularly on things like this. And I know people don't like to pay for stuff. I mean, trust me, people don't like to pay for stuff. I do coaching. And when people actually come to me and say, I really want to spend some time with you, Pete, they still expect me to spend time out of my working day for free. And it's like, I'm sorry, but I do have bills to pay like everybody else. I have to charge. And then they get into, well, I can't really afford it. So these videos are here to give you food for thought, but they're not the final action to help you make the final decision, because there are so many considerations when it comes to making choices when it comes to money. And whilst there's a lot of free information out there, if you really want to make a decision and get to making the right decision, unfortunately, sometimes you're going to have to pay a little bit of a fee to someone who knows what they're talking about to help you execute. And this is a prime example of one. If you are in that position where it is going to be a worry and it's an eminent worry, you should speak to a professional. Yes, YouTube is great from a research point of view, but it's really, really important that you speak to a professional to make sure you can really make the right decision. Someone's saying here, can we ask questions about any financial topic or solely property? Any financial topic. I mean, my background is I'm a qualified financial advisor and mortgage advisor. So I've worked across retail banking, corporate banking, wealth management. So most of the things that I talk about here on the channel, I actually have experience working with. So when it comes to credit cards, current accounts, interest rates, investments, pensions, bonds, equities, all those things, I've worked with those things very, very closely over a 15-year career. Property is not really my forte. It's not my area of expertise. I tend not to try and dabble into something that I don't necessarily 100% know much about. I can give an overview, but not an in-depth answer. Like people will ask me questions about investments, and I can talk to the cows come home with different nuances and contexts. So there's a lot that I can speak about. But when I don't know, I'll say, look, I don't know. You need to ask a question here and there. But a lot of stuff that I talk about here on the channel is because I've worked with it over a 15-year career. And I think that's really one of the things that perhaps sets me apart from other YouTubers who may have an interest in investments because they're learning on their own or they're learning on their own journey. But they don't necessarily have any experience working with this stuff, or they haven't worked in financial services for 15 years to understand how the regulation works and how the scrutiny works and the standards that are required and the consequences of words being said. And so, I should probably sing from the hills a little bit more about that aspect of what I do and my experiences. I don't know. I'm just crap at that. If I'm honest, I'm crap at blowing my own horn and self promoting. Um, and maybe it's a detriment to my channel. I don't know. I really don't know. But I try to be as honest and as open as possible. So yeah, you can ask any questions that you like. Let's have a look. I'm just trying to scan the comments here, guys. Bear me 1 second. So Cameron's asking here, how much do I charge for coaching? It really depends. It really depends on scenario. So that I've got a number of packages. I do like a full holistic review for people. That's quite expensive. But within that, there are behavioral assessments that I take people through, and there's a lot of pre-work for you to do. And within like a financial review, we go through everything. You have to fill in quite an extensive document because I'm trying to get underneath your goals, your aspirations, what you've got set up behind it to make that happen. That's quite expensive. That's 570 for a session. I do one-off sessions which are like 200 plus VAT. That's an hour, maybe 90 minutes or so. That's looking at something very, very specific. Those are the two main coaching packages, my most popular ones. I do quite a lot of reviews for people because what I find is a lot of people will have quite a lot of things going on. They don't necessarily want to go and see a financial advisor because I don't know, financial advisors can be intimidating, right? And financial advisors can be very expensive. So with a financial advisor, if you go and see a financial advisor, they may give you the first meeting for free. But when it comes to taking action, they will either take somewhere between 3 and 5% of your initial investment. So people will say 570 quid is expensive. Actually, I beg to differ. It's not. If you're looking to invest, 20 grand, for example, they are taking a 5% cut of that. And then on top of that, they're also going to be taking about 1% every single year on annual management. So what I do within a holistic review is we review everything, and alongside your goals and your aspirations, I then pull out and say, right, this needs to be a priority. This is what you need to do. This is how you go about doing it. Now, with coaching, I don't offer you advice, but what I do is I give you the pros and cons of all the options you have available. Then I signpost you to how you go about doing that. And in some cases, I've definitely worked with some people where they do actually need to speak to a financial advisor or a specialist because there is a specialist need. But I'm very, very open with people about that. It's not a one size fits all. And for some people, a full review is not what's necessary. For others, though, and it is my most popular one that I do a lot of, I probably do maybe 3 or 4 of those a month with people. They like it because they really get a high level view of their entire landscape. And we poke out, look, this is, you need to get yourself covered here, or you need to do this. and this is the sequence in which you need to do it. And for a lot of people, that provides so much clarity that all of a sudden they feel like there's a weight off their shoulder and they have a plan. That's the whole point of it. We have a plan at the end of it of things that you need to prioritize and make sure that you carry through. And the one for 240 is mainly where there is a very specific thing that people want to talk about. So, Pete, I'm in this situation right now. I'm a little stuck. I think I know what I need to do, but I'm not too sure. And I basically dissect the entire thing and say, right, these are the options, these are the pros and cons, and help you arrive at your right point of action. So just saying here, my mate's dad lost his house after transferring it to him to avoid tax. Mate got divorced and his ex forced the sale. Yeah, I've seen very, 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 very ugly situations with people trying to be clever with putting things in people's names and all sorts of stuff. And even I had one last year where the mum wanted to transfer to the son's name, and he spoke to me just beforehand, because if the mum had transferred to the son's name, he didn't have his own property just yet. He was just about to apply for the help to buy as a first time buyer. If the mum had done that, he wouldn't have been able to buy his own property under the help to buy scheme. So he would have had to work even more to get more deposit. And it's little nuances like that that make a huge, huge difference, which is why you do need to speak to someone who knows what they're talking about. My local financial advisor says that a trust is a worthless piece of paper. Is that true? No, I don't think so. I think there are instances where a trust is appropriate, and there are instances where a trust isn't needed. And I've already alluded to the fact of, in the inheritance tax conversation, which is where a trust comes up the most. It is a way to mitigate inheritance tax. It's a way to put assets in somebody else's name in a legal structure. So sometimes it's needed, sometimes it isn't. It depends on the circumstance of the person who's inquiring about it. And so it isn't one size fits all. Not everyone should have a trust. Also, not everyone shouldn't have a trust. It's all about understanding when it's appropriate for you. And let's not forget as well, setting up trust can be quite expensive, which is even more reason why you need to make sure that it is the right thing. I've worked on cases where, we were going to set up a trust, and yeah, it's 100% appropriate. But in other instances, it's like, actually, you don't need to do that. Just do this. And it works out better for the client in the long run. So I'm just saying, this may sound like a very obvious question, but how would you go about paying off credit card if your income is significantly lower than your repayments and is showing no signs of increasing in the near future? Good question, George. Look, I have been in this position myself. Look, this is what I would do. Okay. So assuming you have one credit card with a large balance, okay, you need to try and make sure. I mean, look, the minimum you need to do is make the minimum payment. Now, there is a scenario where it isn't possible for you to make over the minimum payments if your income is so small. If that is the case, then you need to increase your income. And I know that is much easier said than done. Trust me, I know. I have been in this exact situation. Trust me. And it took me years to get out of it. So I'm telling you what I learned in my own realizations of facing this. So you need to focus on your income. You need to increase your income somehow. Side hustle, new job, promotion, whatever. You need to increase your income, because the only way you're going to get out of that is if you can pay over the minimum payment and do that consistently over a period of time. Ideally, what you want to do is you want to be able to set yourself a really rigid target. And I say rigid because if you break it, the dangers with a credit card is it's a constant revolving facility. It will always be there. It's soul destroying. The credit card and overdrafts, for me, are the worst financial products ever. Soul destroying. Overdraft more so than a credit card, but it's constantly there. It's constantly there. You can be clever and try and utilize balance transfers, but you mustn't have missed any payments. You mustn't have missed any payments. You mustn't have had any late payments. And in this scenario, I can speak for myself. I found it really, really hard because my income wasn't at that level where I could pay more than minimum payments, and some months I missed it. And therefore balance transfers become impossible because they take that as a red flag. He's struggling. And this is the thing that people don't tend to realize. And I speak about this in my book. Your credit score is a reflection of your behaviors and your track record around debt. So credit cards, personal loans, car finance, any money that you borrowed, it's a track record of your behavior and your payments. So the minute it shows up on your credit score that you have a late or missed payments, red flags start to go off. And that means that they're now looking at you as high risk, which means that balance transfers, consolidations, all of that stuff pretty much gets shut off. The taps get closed. Whereas if you're keeping up payments and your credit score's great, they're more willing to open the taps, which is freaking horrible because if you're not responsible, they reel you into even more debt. And I had a friend who was just like that. And so it's a very, very fine line to try and toe. You got to try and make sure that you don't miss payments, you don't have late payments, which can be very, very hard when you haven't got a large income and you're struggling. But you need to have a rigid plan, and you have to have that rigid plan in place. So it might be, I'm going to make sure that I pay off this chunk of money over this period of time on my credit card, and make sure, for goodness sake, you do not carry the credit card with you. Don't carry that credit card with you, because you'll be paying it down. What used to happen with me is paying it down, make a little bit of progress. Something happens, I go use the card again because I haven't got any other choice. I've got no money elsewhere because my income isn't large enough. It's a horrible, vicious cycle. So discipline is really, really key, mate. Having a plan is really, really key. Ideally, you want to pay over the minimum payment. Pick a number that is affordable. So if your minimum payment is 20 quid and you're able to pay 50 quid on top, that's 70 quid. You have to be rigid around that and pay that off over a period of time. And set yourself a target. Within 10 months, I want to pay off 700 quid. So the payments that I make, 700 quid over that period of time, that will reduce your credit card balance. That's what I would say would be the first steps to kind of help. But even besides all of that, you need to try and focus on increasing your income, because if you have more income, you're going to have more capital, more resource to be able to point to the credit card so you can pay it off a little bit quicker. And if you do have a healthy credit score, 0% balance transfers will be a nice way for you to be able to kind of give yourself some breathing space. Cameron's just saying here, buy the book. Yeah, look, buy the book. Look, everything that I talk about, like I've already said here on the channel, in the lives, in the book specifically. So the book is what? Right there. So the red arrow and that QR code, you can scan that QR code. You could pick up off on Amazon. It'll be delivered to you tomorrow. But everything that I talk about in the book, I talk about from my own personal experience. I was homeless because I couldn't budget money. I got kicked out, slept on the streets. That then meant that I got into debt because I realized, well, I'm on the streets. I haven't got anyone to turn to. I don't have any family here. My foster parents, and you'll read all about this in the book. I couldn't go to my foster parents. I realized, well, actually, I don't have any food. I can't feed myself, but I did have a checkbook. And I could go to Tesco's, fill up a basket, write a check, and they'll let me leave with the food. And then the check will take care of itself. I got into debt that way, spiraling. I didn't learn to save early. I didn't learn how to invest early. I started learning about investments when I was 32 years old. You believe that? It's sick. It's sick. Learn about investing and investments for the first time at 32. It's mad, right? So I didn't learn how to invest early. And I certainly didn't learn about credit scores until it got to the point where it's like, okay, I'm in a really good job here at Canary Wharf. I'm earning good money now. I want to get a better car. But guess what? My credit score is shot to bits. I did a video where I was talking about how to improve your credit score about 3 weeks ago. You know, at the moment, I don't have any credit cards. I don't necessarily use them. I do have some. I've got like credit limits on them on like 2 cards. I never use them. I think the last time I used it was 2021, 2022, early 21 to early 22. That was the last time I used a credit card, and I paid off the balance in one go. But I don't live off credit at all. So everything in the book, I tell my story behind all of the principles that I share within that basic formula to inspire people, to let people know, look, you may feel like you're in this on your own. You're not. A lot of people go through the same thing. And it was only right, if I'm going to write a book, that I tell my truth and my experience to help you know that you're not on your own. Because it's a very dark place when you're struggling with debt, you're struggling to make things meet, and you're under financial pressure. Like it can feel like the world's crumbling around you, like you haven't got a lifeline. And I've got news for you, mate. It's only temporary. Getting out of it is possible, but it just means that you've got to be a little bit disciplined. So if you pick up the book, you'll learn so much, mate. I put a lot of effort into trying to structure people and take people through a journey in it. There's some practical stuff in there. You'll set goals. You'll go through the wheel of life. You go through the wheel of finance. There's some really, really good stuff in there, mate, in terms of exercises that make it practical, that help you move along in a practical sense as well. So yeah, go pick up the book. But Cameron, kudos to you, mate. Cheers for that shout out, dude. Ever seen Caleb Hammer's financial audits? I'd love to see a UK version of that. I've not seen that, mate. I've not seen that. You know what I would really love to do? I was at an event yesterday because my publisher is HarperCollins, so they're the second largest publisher in the world, and they had an event yesterday in London at the Victoria Albert Museum in Kensington, and there were just I thought there were going to be like, I don't know, 40, 50 authors there. There were hundreds of authors there, best-selling authors, and there's little old me. And I was speaking to someone, and we were talking about my book and the kind of things that I want to do. And he goes, you should do a show like I think his name is Ramit. There's a show on Netflix called I'll Teach You to Be Rich. I want to do something like that. I would love to do something like that. It's kind of what I did on Secret Spenders, but a lot of my session, I ran full like 90-minute sessions with the people on the show, but they cut it down to like 2-3 minutes, 5-minute segments. I want to do something like that where we talk about people's goals, aspirations. I take people through behavioral assessments and I cannot stress enough how important behavioral assessments are. Understanding why you make financial decisions, why you make the choices that you do, and how that translates into your behaviors when it comes to the money that you spend and how you interface with money. So important. I'd love to do a show like that. So I will have a look at this one though, because I've not seen Caleb Hallemer's financial audits. Could be an idea. Just getting things commissioned are so difficult. It's so difficult to do. Parent home is on interest-only mortgage with 5 years left. I would like to overpay it. How do I end up owning it? Oh, dude. Okay. The thing is, mate, they just can't gift it to you. And yeah, you need to speak to a mortgage expert on this to see what the options are. I mean, I don't know how much is left on it. Because at some point they will get a letter saying, look, the mortgage term has ended. You need to cough up this amount of money. They could sell it to you. They can't sell it to you for a massively discounted rate, though. That's not allowed. You need to speak to a mortgage advisor, a proper practicing mortgage advisor, or an expert who can advise you on that specifically. Because yeah, it can be very, very tricky. Really, really tricky. Pat, how you doing? Yes, I do coach her son, Kamar. Yes, and he has seen great. But Kamar's very, very clever. He's a really, really clever kid. So, so clever. But thanks for that, Pat. George, thank you so much for your advice. You do not know how much I appreciate it, mate. Thank you. Oh, thank you for being here. Thank you for spending the time with me on a Thursday evening. But I'm just going to see and scan what I've got because I'm just conscious of time. We're an hour 13 into this now. Let me just have a look. I'm about to be 32 and haven't really been intentional about investing beyond the bare minimum on pensions and ISAs. Am I screwed? No, you're not. You're only 32, mate. So you got plenty of time. I think the important thing for you, and again, if you are my coaching client, what we would go through is we will go through like a timeline exercise. We'll look at all your priorities, look at all of your goals. We'll put them on the timeline, and then we'll have a look at what goals come first and what priorities you need to pay attention to first. Because it's all very well and good talking about throwing money into pensions and ISAs, but if you want to buy a house, a pension isn't going to help you buy a house. An ISA might, in a lifetime ISA, is all about, again, you've got a toolbox of 15 different tools. Which tool is the most appropriate one for the job? So that's the kind of stuff that I would go through in coaching with someone like yourself, but you're not screwed, mate. You've got plenty of time. You're only 32, so you've got plenty of time. It might not feel like it, but trust me, you have. Hmm. So to say, bro, yes, do a Netflix version of that guy. Would love to do this, but lack the qualifications. Hey, dude, listen, man. If you want to get qualified as a financial advisor, it's a lot easier than you think. It really, really is. You gotta have the time to dedicate to it, but it's a lot easier than it is. Believe me, and trust me, I can tell you this right now. The financial services industry. Well, no, the financial advisor industry is screaming out for young people. There's not enough young financial advisors coming through. And if it's really something you want to do, message me on Instagram, mate, and I'll point you in the right direction. do, do your brain hurt with all that you know? Look, you know what it is, mate? It's because I've worked in it for such a long time. I think for me, it's normal. So when I say things sometimes, I'm like, oh, yeah, everyone knows this. Then people remind me, actually, no, people don't know this. So I have picked up a lot of information, a lot of knowledge through 15 years. And I'm really, really blessed that I've not just worked in one area. I have worked in retail banking, working with customers, right? So credit cards, overdrafts, all of the bank stuff that you see day to day. I worked with all of that, all of it for a very long time. Corporate banking is just the same thing, but with businesses. Then wealth management is pensions and investments and so on and so forth. And I've been qualified in to be a financial advisor since 2016 now. So I've just picked up a lot and I retain a lot of information. So it's almost like second nature now. And just having these kind of conversations, it kind of it helps my brain just keep things to the top, to the surface. And I like talking about the nuances and stuff like that. I don't know everything, and I wouldn't profess to say that I know everything. I could probably definitely, sharpen up on my knowledge bank. I could probably take a few more exams, but I'm not a practicing a financial advisor anymore. So what would be the point of actually doing that? I think for YouTube purposes, for the purpose of having these kind of conversations to help people who perhaps don't know as much as I do, I think my knowledge base is pretty solid. And again, I think that really sets me apart from other YouTubers, because a lot of them, they don't work in the industry. A lot of them are actually accountants, and that really pisses me off. It's like if someone asks me about, what tax do I pay in a year, I'm not going to step on the toes of a tax of an accountant and be like, oh, this is how you do your tax, blah blah. Like, it's not my bag. Like, that's not my area of expertise. An accountant is an accountant. An accountant is not an investment expert. It drives me nuts. It really, really does. And a lot of other YouTubers as well. They just, they're learning their own. They're learning how to invest themselves. And I'm not necessarily like that. I've worked with this stuff for a very long time. I've advised on this stuff, and I just try and be as honest and as, I guess, transparent as I can in the kind of conversations. And you know what? Someone said to me the other day, because it does frustrate me sometimes. I look at my subscriber count, 41,738, something like that. There are other accounts that don't have the background that I have, don't have the experience that I have, that are 100,000 plus subscribers. You look at their videos, they're getting 15, 16, 20, 25, 30, 40,000 views per video. My average is probably around about 1,000, 2,000. It's always been like that since I started in 2020. I don't know how to push it beyond that, because I would have to compromise on my style. My style is to be conversational. It is relatively boring. I'm not talking about the shiny, this is going to get you rich, because that's not who I'm aiming this stuff at. I'm aiming it at people who really want to know the detail, who really need to understand the information to make the best decisions, not get rich quick or looking for quick, turnaround things here. So I've kind of come to terms that this is, the trajectory for my channel, and that's completely fine. It is pretty hard to swallow sometimes. It really, really is. I mean, you talk about the when did I do the last live session? Super chats, massive, massive help. I don't get a lot of them. I don't generally ask for them. But if you think about, my work and my effort, if I looked at it purely on the time that I spend on lives, an hour 18 for this live specifically, the AdSense will probably be something like, I don't know, if I get 1,000 views, maybe £20, for an hour and 18 minutes. So people will say, actually, that's a good wage. But actually, given the value that I've given and the topics that we've spoken about, if you were sat with me as a financial advisor and this ended up being something that translated into investment business, you'll be paying in the thousands. So it's swings and roundabouts. I'm very picky with the brands that I work with. I don't have that many sponsors on the channel anymore. I'm very picky around that. I do this because I enjoy it, and luckily YouTube isn't my only source of income. I've been able to diversify my income through YouTube, and that's been a blessing. But sometimes things aren't always as rosy. But I am financially responsible, so I know how to structure my finances. So I'm not necessarily desperate, but it would be great. Don't get me wrong. It would be fabulous at some point to get this channel to, you know, 10, 15, 20,000 videos per view. Because at that point, the channel alone is sustainable. I would be able to do the channel purely, solely on its own without doing anything else. But at this point in time, it's not there. So it's diversifying and try to do as much as I possibly can, really. Somebody's saying here, I agree. From your content alone, you should have way more subscribers. Your stuff is solid. Thanks, mate. Look, you don't always get what you feel you deserve, right? And that's all right. It's okay, cool. It's because you're not clickbait, which I am grateful for. Yeah, I try to intentionally not be clickbait. I mean, so the screen grab for the video on Tuesday where I put bank run, I literally sat with that thumbnail for like 20 minutes thinking, I don't want people to click on it because they think it's clickbait that I'm trying to scaremonger people. And I think that for people who take the time to watch and listen, they know that that's not my intention. But even as that, as a thumbnail, I sat with it thinking, maybe it's a bit too clickbaity. But there wasn't another way for me to be able to convey the topic and what we were going to talk about in like a short caption. So I went with it, but it was still very uncomfortable. Spencer, I've got a question. I'm overpaying by £1,000 a month. I'm on my last year on my mortgage. The plan is to move and take a small mortgage out on the new home. What's best? Keep a small amount of the Spencer. Where's the rest of it? Okay, before I pay it off, or pay it off beforehand. Will the banks look at me in a better way if I still have a mortgage? In that example, mate, what I would do is um, so you're going to sell. You're going to sell You're going to sell and buy a new place. So what you could do, sell. Yeah, sell. Well, you've got enough equity, haven't you? So you don't really need to pay it down and pay it off if you're going to sell, because when you pay it, when you sell the property, you'll pay down the remaining mortgage. Then you have a chunk of money. So you just simply just go buy a place that's smaller amount. You'll have a chunk of money left over. So don't overcomplicate it, mate. I think you don't have to pay anything down because you're going to sell. So when you sell, you just pay off what's left on the mortgage, retain the money that you have here, because that will be added to the amount that will be left over as part of your equity holding once you pay down the mortgage and bought a new place. So that's how I would look at it. Don't complicate it too much, mate. You should do some merch. Would love to support you beyond the book, and someday I'll be able to book a few sessions. You know, I have thought about merch. I've thought about merch for a long time, actually. I actually designed some. But you know what the issue is? The YouTube, how you do merch with YouTube, like the delivery and the lead times are way too long. I mean, look, and literally pricing it, I almost press a button in. I would have to charge like 35 quid for a t-shirt just to get like a tenner out of it. The production cost is so high because it's the production cost, it's the packaging, it's the posting, essentially. And that's why I haven't done it. But I actually had some designed to be able to do. And so I haven't done it, but I might have another look at it. I need to find a way to do it in a cheaper way. And in a way that will be automated where the cost can be kept down, so I can actually keep the cost of the merch down as well, because I just don't feel like it's right to charge 35 quid for a t-shirt or hoodie. It's way too much, mate. It's way too much, and the numbers were that high. But I might have a look and see if there's any other way you can do it. Again, if you do it externally beyond YouTube, you have to do certain quantities, and then you've got to think about postage and packages and stuff, postage and packaging. So the margin, the price isn't too far off that 35. You could probably get it done for like 25 quid. Would someone pay 25 quid for merch tees? I don't know, or hoodies on the channel. The big channels I know have it, but they have more bargaining power with YouTube and with merchandisers. I don't know. I will have a look at it. It's a good suggestion. Thank you. Hey, Joanna, how you doing? You'll be able to watch this from the top. We've been on, we've been on it for quite some time, actually. I'm actually quite enjoying this, so this has been really, really good. Um, yeah, I do. I do know what you mean. Look. It will be easy for you. It will be easy for you to borrow more if you need to borrow more if you're still on the ladder than if you paid off the mortgage altogether. So that's why I'm saying. You know, try and if it is a case of the equity you have in the property after you sell is enough to buy without you having to borrow, do that. But if you do need to borrow, don't pay it off. Don't pay off whatever you have left. Keep the mortgage, borrow more, and then do whatever you need to do. Michael, how's it going? Starting to get twitchy with my mortgage review due on August 24th. Mate, who we should speak. You're in my accountability group, mate. You need to message me. That's what the accountability group is for. So message me, and let me know your situation. I can maybe offer some help on there, mate. So yeah, don't get twitchy. I mean, I don't know what your situation is, mate, but hopefully you've been looking around at the interest rates. Interest rates are they're nuts right now. It's mad. It's really, really mad. But yeah, send me a message. We'll talk. Joseph said, I got to admit, I don't always listen because I think most of the content, as for under 14s, and most of them are way under money savvy than boomers. Yeah, that's true. Sunny Times is saying here a slight left field question. What's your thoughts on more help specifically for single people trying to get a property? I feel the system benefits more those couples in a combined income. Yeah, look, mate, it's a really, really good point. The trouble is, mate, if you're in a couple, you're able to pool resources, and you. So, for example, your lifetime allowance becomes two, right? And whereas for a single person, you haven't got anything else to pull. Could they offer more help? I mean, there are arguments that they need to come up with another help to buy scheme of some kind, some support. Would they see? It's a catch-22. People are saying that property is going to fall by 35%, right? So one of the things that the government could do to counteract that is to offer something like a help to buy. But the thing is, where's the money going to come from? If they haven't got the money, they can't just print it because that will make inflation even worse, right? So any incentive that they introduce to help people, they have to fund it. And at the moment, the economy is not in that place where we've got the cash to be able to do it. I mean, our debt is 102% of GDP, which means that if you're looking at this from a personal finance point of view, we are spending more than we actually have coming in. And that's not a good place for anywhere to be. So the government can't just, say, right, we're going to introduce a new scheme to help people. They would have to turn on the printer. That makes inflation worse. So it's a really precarious situation. But I agree with you. There is more help that needs to be done. And at this point, we need really solid economic ideas, in my view, to be able to get to the point where um, tangible help is going to be able to be rendered. How do you join your accountability group and costs? So the accountability group is 9.99 plus VAT. So there's a small group of us in there at the moment, and basically what we do is we set weekly goals. We meet once a month. So last month we had an in-person meet in London. This one, the one for this week is going to be on Saturday. It's going to be online. It's going to be Zoom. But there's a small group of us. We get together. We set some goals. We all communicate here and there within the group and outside of the group as well. So for example, Michael's part of the group. He's starting a podcast right now. And by the way, guys, you should definitely go and Michael, what's your podcast called? Put it in the chat. Really, really good. Particularly if you're the kind of person that wants to you're looking at changing career, or you're looking at career progression. Awesome. So, Michael's in the accountability group. And I like to help people as much as possible. I've got my podcast that goes out on a weekly basis. Mike's just starting out. So I've allowed him, to use my Riverside FM to get him started on his first few episodes. We try to be as helpful as possible to each other. It's all about accountability, being supportive. It's having an ear, a tribe of people that kind of are aiming for the same thing. And it doesn't have to be, business goals or professional goals. It could be simple fitness goals, right? There are a wide variety of people. Kamar, who I also coach, young man, he's also in there with his mum, Pat, who was in the comment section earlier. So his podcast is called Catapult Your Career. So it's a brand new podcast, but I've got 3 years experience in the podcast, so I try and help Michael out there. And we just try to be as supportive as possible. And the idea is, if you have people like that around you, you're likely to go further with people than if you didn't. That's the whole idea. In terms of joining, I don't have a link in the description, purely because I want to keep it really, really small. And this is where I'm really bad. I don't talk about the things that I have on offer because I feel like I'm selling to people. People are like, no, dude, you should be selling. Like, you should really be selling. And maybe that's just me being naive from a business point of view, but I focus on delivering more value than anything else. And so if people want to join something that I'm part of, they're more than happy to do that. But I'm acutely aware I don't make it easy for people to use me for coaching. And I'm revamping my website right now to make it a little bit easier for people. But currently, if you go on my website, peterkomalafe.com, and you go onto individuals, the accountability circle is actually on the website. So you can join there. And once you join, message me on if you DM me on Instagram, I'll send you a link to actually join the WhatsApp group as well, because it's all based in the WhatsApp group. Will do. Is the shirt another Zara banger? No, actually, you know what? I'm going to surprise you. It's not what you wear, it's how you wear. This is Primark. This is a Primark shirt. And people are like, oh my God, this is so nice. I'm like, yeah, it's Primark. It's cool. I got maybe like 3 or so from Primark over the past, because I went to Dubai was it last week? Last week. I went to Dubai last week. So just before I went away, I went into Primark and got like 3 of these, different patterns and variations and stuff and different colors. But yeah, it's from Primark. Ah, just a clarification here. I meant that the under 40s are way savvy than us boomers. Yeah, I mean, I think, I don't know. You know what? I think it is because the world is a different place. It's a really, really different place right now. And I think people have had to learn the hard way with the under 40s. I mean, I'm 43 and I've had to learn a lot of stuff, like, and get myself together, like, because the world is a very different place. Final salary, pensions, all that kind of stuff doesn't exist now, so you've got to be on your toes. Hey Pete, you mentioned the need for more young financial advisors breaking through. Would it be delusional to transition from a burnt out senior software engineer to this field? Do you coach on that? Mate, listen, no. I know people who have, there is a follower on this channel who actually qualified as a financial advisor through watching this channel. And he messaged me about a year ago, and he follows me on LinkedIn now. He's a full-fledged financial advisor. He changed career completely. So he wasn't in financial services. I can't remember what he was in, but he was in a completely different career. He got his qualifications. Now he's a financial advisor, and he goes, it's the best thing he's ever done. So you don't have to be from an industry to be able to do this. You don't. You just need to be able to, you need to know the path to take. And I can point you in the right direction. It's not something that I can coach on because you have to go through a course of qualifications. You need to be connected with the right people in terms of putting what you learn into practice. But mate, if you message me on Instagram, the handle's still Conversation of Money. Message me on Instagram and I can point you in the right direction. But believe me, the industry is crying out for young advisors, really, really crying out for young advisors now. And, as much as financial advisors do get a lot of stick, it is very, very lucrative. Sometimes people say, Pete, I could, if I wanted to, have my own practice. And I played around with the idea of it so much, because the reality is that I talk a lot about investing the money and all this kind of stuff. And I've had a ton of people say, look, I want you to manage my investment portfolio because I've been watching you for such a long time and I trust you. And the reason why I don't is because, number one, I don't want to deal with the compliance. If I went back to be a financial advisor, whether I'll be able to do this would be a serious piece of consideration. I mean, I walked away from it to do this because it's too hard. You can't say this. You can't do this. If you want to put something out, you've got to have it approved. And then they basically cut your balls off in terms of what you can say, how you can say. And I'm like, dude, I just want to talk to people about stuff. I don't want to be restricted of you can't say that, or you can't use the word should. You need to say could or would. I don't want any of that. So if I were to have my own practice, this whole thing becomes is under risk because compliance will try and snip at me basically. But the upside from a business point of view is I would probably gain a lot of people who I could manage investments for, I could earn fees on. And what most advisors do is they wait until they have 10 million under management, 20 million under management. Imagine you have 20 million quid under management, right? And this is why a lot of the it's so lucrative. 20 million pounds under management taking 1% per year. 1% per year. It's £200,000 before you even wake up. A lot of financial advisors build businesses that they then go on and sell. So if you think about an advisor who maybe has, I know advisors with 150, 200 million under management with a 1% fee, it's 2 million a year, who then go on and sell after they've enjoyed 2 million a year in income. And yes, they have fees and so on and so forth that they have to pay, and it's not cheap. They then go and sell their business on for 4 or 5 times their recurring income. So if you're getting 2 million a year, imagine you're selling for 5, 8, 10 million, and they retire in the sunset. Those crop of advisors are all coming to retirement stage, and there are not enough young advisors to take their place. And so it is a very, very lucrative and very, very financially rewarding career to go into, but don't go into it just for the money. You have to be willing to do a good job and connect with people. Financial advisors ultimately deal with people, but they deal with people's money. But the person comes first. And all of the successful advisors that I've seen, who I've worked with, who I admire, have that at the forefront of their mind. They care deeply about their clients, and the money is just a secondary factor. It's a reward for the good work that they do for their clients, and advisors do get a bit of stick. They do, because at the end of the day, they don't have the best track record. And I've certainly met financial advisors through my 15-year career who were fucking tossers, like complete assholes, wankers, only up for themselves. But I have to say that's a very small percentage of the overall advisors in the market. And there are some very, very good advisors who do very, very good work. And the reality is, it's a very specialist environment. A lot of these guys study for years, and it's continuous studying as well. They have to do CPD every year to make sure they're up to date with the latest tax, trust laws, every investment updates, all of it. It's like literally being a doctor. You're continually having to improve your standards and your knowledge, and it takes a lot of effort. And so when they charge people, people don't often see the value in what they charge for what they do. But I think that's really down to the industry. It's their fault. And I stepped away because at the end of the day, you need to have these kind of conversations without having to go to a financial advisor. I'm a gateway to a financial advisor, in my opinion, in what I do in coaching. It's for the person that knows that they need help. They don't want to go to a financial advisor because they're worried about the fees that they're going to be charged, and they just want a sounding board, someone to give some direction and some guidance. That's me. You may get to me and we have a really honest conversation and say, look, you can do it, but these are the risks, these are the problems, or actually you need to speak to an expert because of X, Y, Z. And I give you clear reasons. And a lot of the time when I do work with people one-on-one like that, I will say, look, there are 2 options. I can give you an online engine, unbiased, go find one on your own, or I can just introduce you to someone that I know will do a really, really good job for you. And I have referred a handful of people over the last few months or so to one of my very close friends who is a financial advisor. He's actually getting married at the end of this month, and I'm going to his wedding. Great guy. He's been on this channel actually a couple of years ago, Terry. And those are the people, and I do a handover with him. I sit in on the first meeting. I sit in on all of the meetings, ask questions that maybe they wouldn't necessarily ask or think of asking, so they feel comfortable. And it's up to them whether or not they decide to use him, but at least they then get the expert advice that goes along with it as well. So I'm a conduit at the end of the day. I'm a conduit towards that. But, look, trust me, you don't have to be in the industry to get into the financial advisor field. It's very, very lucrative. It's very, very rewarding. It's tough. It's tough. The standards are extremely high now, extremely high. But the industry is crying out for young people, for new blood. So what's up? Is there a workaround to remove your pension as a 25-year-old before the age of 55? What's the best way to tax-wise to go about this? You can't access your pension before the age of 55 unless you have some special circumstances, diagnosed with a terminal illness, maybe something like that. But the rules are the rules. You can't access before 25. All right, okay, cool. One final thing, guys. There are still 74, there's 67 likes. Do me a favor, let's match the views, the people online right now, to the likes. So we need 8 more likes. 8 more likes to get it to 75. That will match the number of viewers that we actually have on the stream. We are in 1 hour 40 at the moment, so I'm going to call it a day here. I will do a finance clinic on Sunday evening, so it will probably be around about our aim for 6 p.m. I will schedule it. So if you are watching this and you haven't yet clicked the bell icon, make sure that you do that, because when I schedule it, you'll get the notification to say that I've scheduled the finance clinic on Sunday. So we can pick up a lot of this stuff Sunday evening. We can talk. We can exchange questions and answers, so on and so forth. If you want to bring a friend or, recommend it to someone who might benefit, who has some question of their own. People always have questions. Like yesterday at the event, people said, "Oh, what do you do?" I'm financial advisor. I'm looking to buy a house. What do I do? People always have questions. So if you can share it, that will be amazing. We've got 74. Thank you so much, guys. I appreciate you. I'm going to see if I can get to the cinema because I do want to see the new Indiana Jones. So enjoy the rest of your evening and enjoy the outro.
Yeah, surprise, a little different than you're used to. Yeah. Dropping these balls on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you, yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coke. While I'm researching these stocks, buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.